And we are live. Assalamu alaikum wa rahmatullahi wa barakatuh, everyone. This is another one of those impromptu live streams that we've been doing recently to make sense of all of the noise that we're seeing in the investment landscape right now. And we've got probably the person that I would most trust when it comes to getting a hot take and getting a perspective on investments in the room with us today. He's a certain Mr. Mayur Jethwa, who has previously had a very long and august career in the city, trading all sorts of different things. And you were previously at Bank of America, Merrill Lynch, Credit Suisse before that, and you've got a lot of experience, Mayur, in dealing with crises and dealing with a hell of a lot of volatility. And you've seen, I don't know how many crises you've seen at this point. And today you're retired, thankfully, and you're managing your own money, but the crises keep coming. Mayur, assalamu alaikum and welcome.
Wa alaikum salam. Thank you. We have 3 young kids at home on Easter holiday, so the crises are rolling forever in this house. But it's all part of the fun.
Fantastic. So, folks, what we're going to be doing today is we're going to be giving you a bit of an overview on what on earth has been happening in the markets. A lot has been happening. And then we're going to start thinking about, how should we understand all of this right now, all of this noise that is coming at us? What are the framing principles that allow us to start making sense of what's happening? And then we'll get into the specific tactical stuff about, in the immediate short term, how would a expert trader, an experienced trader be positioning, and how would they be thinking? And then also longer term, how would we, as investors, and perhaps even, as a country or as a community, be thinking about, how the composition of our portfolios should be looking. So I'm very excited to dive in. I guess, Mayur, just to set the scene for everyone, a certain Donald J. Trump has announced tariffs that he did very proudly in the gardens of the White House, and China came off particularly badly. And then basically within a day, the markets were in turmoil. Within a few days, he had effectively said, no, actually, you know what? I'm going to put a 90-day pause on everything. So everyone is going to have this kind of baseline 10% tariff. But then China in particular, we're going to go after them. And the whole narrative was that, look, China, came back on with us, came back with some, retaliatory tariffs. And so we're now going to really punish them. And so they continued that. But then after a while, they said, Xi Jinping should reach out to me and I'll have a conversation with him, said Donald Trump. He also has then reversed in the last few days tariffs around mobile phones in particular, and potentially computer gadgets. But then in classic Trump kind of behavior, he said that maybe that's temporary. And so it's just kind of keeping everyone guessing. And it's been pretty chaotic. And I'm going to share a graph of the stock market, but I also wanted to get your perspective, Mayur, on how how you've been seeing what's been happening.
It's quite funny and ironic in that the Trump, or President Trump, and I guess the Trump administration have kind of just done exactly what they said they would do. But of course, nobody believed that they would really go through with this, and nobody really believed that they would do it in such a manner. And so if we've probably, I'm sure media has lost count of the number of times Trump flagged that the tariffs would be a central part of the negotiation tactic and the economic reformation plan. And you've also had others in his administration that are very well versed in these matters, who have kind of spoken to the same thing. So I think an important thing to distinguish is what's being done, which was very well telegraphed, versus how it's being done, and just the abrupt nature and seemingly haphazard way in which these things are being deployed. Although, of course, there is another argument that this is all part of the negotiation tactics, which Trump has also spoken about and I believe written about and is well known for. So I think amidst all of that, there's a lot of noise at the moment. There's a lot of reconfiguration in the markets because, a huge dose of uncertainty has kind of been thrown into the ecosystem. But if we take a step back for a moment and take a look at the bigger picture, I think what's happening in some ways is not necessarily the way it's being done, right, but the what is being done. One could argue, is quite rational and perhaps could have been anticipated, right? And so what's happening, not just the US, but certainly, the US is by far the biggest of the major economies in the world that are finding themselves on a somewhat unsustainable, debt trajectory, right? It's post-COVID especially, but also, preceding that, we were in a highly indebted kind of sovereign state, which is proving increasingly difficult to kind of grow into, right? It's harder and harder to grow into that debt burden. And so it means that you've got to think about unconventional measures or other ways to tackle this, right? Because growing into the debt burden, which you'd kind of say really started almost, my history goes back to the financial crisis and, a little way before that. Prior to that, I don't remember sovereign debt as being such a big, topic or area of concern. But it's been something that's, been kind of growing gradually and as I say, kind of accelerated post-COVID. And so what do you do about it? What can you do about it? Well, ultimately, if you do have this kind of inflationary backdrop that persists over 10 or 15 years, your debt stock is losing value in real terms, right? You're almost inflating away the debt. So now the question is, how do you do that in a manner which doesn't destroy your economy, right? You need to find ways of stage managing this process. And the person who really is, I think, the expert on this, and I'm sure there are many experts, but the one that matters for us at the moment is the Treasury Secretary, Scott Bessent. He's very well versed in these tactics and in this field of play. And so my guess of looking at what's going on is to say, well, we need to devalue the dollar, right? And in doing so, we can probably afford we will naturally have higher inflation as a consequence. We will have a higher base level of interest rates, but we can kind of grow into that because we're going to take back some of these lower income manufacturing jobs and so on and so forth. And so real wage growth will be backed, with a good GDP growth impulse as well, right? So it's a very dangerous game to play, I'd argue, because inflation expectations can run away from you quite quickly, and you can risk breaking a lot of things along the way. But there is some rationale to what they're doing.
And do you think, Mayur, that because Trump, the way he carries on, he doesn't necessarily strike the world as someone who has an incredibly detailed plan, but those around him perhaps are a bit more switched on, and they often will put on him that this is what the plan is, but then he sometimes changes it as well. And I guess my question is that is it like, are you kind of harking back to some kind of, I don't know, like basic principles of just economics, that okay, there's this kind of Trump figure who's going to do mad stuff, but there's like this kind of general trend that he's being forced to do mad stuff in the direction of?
Yeah, I think certainly there's part of me that's trying to rationalize what's going on, right? That's just taking a very basic pragmatic economics 101 look at it. And saying, well, actually, if we go back a few years, there are so many conversations I would have had and so many people that will talk about, well, the debt dynamics are not sustainable, right? And we saw this with the Liz Truss episode, right? Where, all of a sudden it's like, people lose trust, in your sovereign debt very, very quickly when you don't have a viable plan out there, right? But equally, there's a large contingent of people that would acknowledge that the UK is on a very precarious trajectory when it comes to financing its own deficit over the long run, right? And so we need to do something. And so, different regimes have tried different things along the way. And if you go back to basics, I could also, argue as to why this is a very dangerous and risky plan, but there is some rationale to it. That's my point. Now, look, again, the first thing I'm starting with is let's distinguish the what's happening and how it's happening. But I think that the how it's happening also warrants, you know, a few minutes of conversation, right? There was an old adage from my economics teacher, which always comes to mind, actually, in times like this, which is that if you owe the bank £1 million, the bank owns you. But if you owe the bank £1 billion, then you own the bank, right? And so I think there's a risky strategy here insofar as to say that, you know, the Chinese finances are so intricately linked, you know, with the US capital markets, that they are not going to want to do something that's disruptive to their own asset base, right? To their own savings pool, which is not entirely, of course, but there's a large portion, a meaningful portion, which resides in US treasuries, you know, and the like. And so in that regard, you know, there's a dangerous game of brinkmanship of like, yeah, it's going to hurt us, but it's going to hurt you more. So, you know, come to the table and let's have a conversation. But there are a few other things that we need to keep in mind here as well, that this hasn't just been targeted at China, right? You know, you've got some of the closest allies that have been left by the wayside, Canada being, you know, the most obvious and notable, who are probably scratching their heads as to thinking, you know, how did that happen? Right? What did we do, right? And so, you know, to have...
And what did the UK do? We got 10% for no reason. I mean, we're in net surplus.
It feels like we got off lightly because, you know, anyway, let's not go there yet. It may have been more... It may have been a lot easier, right, to have a cohort of countries that are working, you know, with the United States to help rebalance world trade, right? But it's kind of alienate everyone, including your closest allies, and then to say, well, you know, they're the bad guys over there, let's go get them now. It's like, well, hold on a second, everyone's, you know, looking for their own exit. And so it's unclear as to how this will play out, you know, in that regard. There's also a different dynamic from the Chinese perspective, right? When we look at how this is being done, the timescale that I suspect the Chinese are looking at is very, very different to the US, right? The US, within the next 18 months to 2 years, you know, the focal point will be on the midterm elections, right? Where, you know, Trump's ability, you know, to pass such strident legislation, you know, really hinges on, you know, kind of cohesion within the parts of the US, you know, government and the legislature. And if you lose that, then, you know, that's a whole different dynamic within the US. And so, again, I suspect, I don't know, but, you know, Chinese are probably looking at this thinking, well, you know, we kind of need to just live this out for the next 18 months, right? And then let the US do its damage to its own economy. And then the midterms will kind of, you know, change the lay of the land anyway. And then, you know, let's kind of play the long game through all of this.
We were talking, sorry, Mayur,
No,
I was saying we were talking about Ray Dalio, and I want to come to him, but I wanted to share a really interesting article that I came across as part of the research around, you know, the whole thing about, you were saying about how they're happy to just wait it out. And this is an article in Foreign Affairs written by a guy called Adam Posen, and he's basically saying that, look, the US is saying that this is a big mistake, Chinese escalation, because they don't have any, you know, decent cars that they're holding, because we export 1/5 to them of what they export to us. But he's saying that this logic is basically wrong. It's because, you know, the reason that, you know, what that's actually describing is that the United States gets vital goods from China that it can't really replace anytime soon from anywhere else. And that China, on the other hand, China may be losing money, but it's not actually losing, you know, the goods as such. And so, and actually, interestingly enough, he says at a later point that, you know, China, because it's actually got a net surplus, and, you know, it's got people who are saving too much, you know, China actually has the money to be able to deal with it. And because it's, you know, a communist country, and it's because it's, you know, much more centrally controlled, it can deal with a lot of the, you know, the short-term, I guess, pain that comes from, you know, having to, you know, make the policy changes to kind of navigate this next 18 months. So yeah, I thought that was a really interesting take. Interested to hear your views on this as well, and then yeah, love to get into, I guess, the Ray Dalio analysis that you were sharing before as well.
Yeah. I remember this, a very similar phenomena throughout the European debt crisis which would have been around kind of 2012 to 16-ish, or probably before that, but kind of peaked around 2012. And what is that? Working in a large US organization, you tend to look at things through this US lens, and you apply your own framework and way of thinking, and to other economies and to other cultures in the world. But they don't necessarily work like that. They don't necessarily think like that. And certainly, if you look at the autocratic nature of the Chinese leadership, it does bestow a great deal of benefits, right? Look at how quickly China have been able to become a world leader in electric vehicles, solar technology, and God knows what else, right, that we don't even know about. Certainly manufacturing, they're leaps and bounds ahead of anywhere else in the world. And there's also another, there's another different, dynamic that also comes to mind. A few months ago, everyone was jumping up and down about AI and how it's going to take over everything and so on and so forth. But if you think about the real value of AI as we fast forward a few years, it may not be through the ChatGPT and so on and so forth, but it may well be through the manufacturing process, right? And so now the US is kind of upending the world economy to bring back a whole load of manufacturing jobs back online, which ironically in a few years may be done by machines and robots, right? It's not hard to fathom, it's not hard to understand. It's quite a plausible evolution of things. And this whole thing, this whole change, may precipitate, some acceleration in that regard. But anyway, to your point, yes, I think the Chinese priority list is perhaps very, very different, right, to what we have in the UK, to what there is in the continent, in Europe, to certainly what there is in America. And to think that the Chinese, are entirely committed to, just nominal GDP growth, and that's the only thing that matters, may be a misunderstanding of their cultural, political and economic priorities, right? And so I think it's quite hard to read that game theory on, this is how they're going to react, and it's going to be the same as what we would do.
And weirdly, I think actually reflecting on it, I think China is always going to be, I mean, maybe not always, but China is the big advantage that a communist or kind of more centralized system that China has is that they're always going to be playing the long game, and they're just going to be much better than America at the long game. I guess the flip side of it is that the Americans are always in a bit of a hurry, and so when it comes to the speed, the sheer speed of innovation, the Americans are probably faster. So I guess there's like the kind of the cultural side can actually go both ways.
It does, yeah. I mean, very much so. Look, and having spent most of my career in US orientated organizations, and certainly the large part in a large US bank, I'm almost wired to that act first, can ask questions later sometimes, and I've seen and enjoyed great benefits of that approach. But here, you got to remember, you're not, you're dealing with very, very large economies. It's people's livelihoods. Like it takes a while to turn the oil tanker, and when you're dealing with moving herds of people, sometimes it takes a generation, right? It takes 5, 10, 20 years for these things to unfold. And I think there's an interesting segue, right, for a moment, just to pause on, which is to say that this isn't the first time that the global economic order has been reorientated by the US, right? The Bretton Woods system was less than 100 years ago, right? I think in the 40s from memory, but my economic history is a little bit hazy on this. But it was there or thereabouts. And what did this follow? This followed, the action of tariffs in or around 1930, right? And so you almost had a 10 to 15 year window of flux in the US, right? Punctuated by very significant global events, right? The Great Depression in the US, World War II, right? Now, I'm not drawing any links in terms of causality and so on and so forth. That's a different matter altogether. But I'm just saying that this period of turbulence, existed once before then, and it happened again in the 70s, right? And then what came to fruition was, the infamous New World Order, I guess State of the Union speech by Reagan, which followed, I guess President Nixon's unconventional measures, right, to reorder the global economy, because again, the US was being hard done by. And so I guess I certainly have some level of sympathy, right, for the US perspective on this, to say, look, we keep trying to build this rules-based system. People are using regulation, currency manipulation, and finding these underhanded ways to undo us. We're not stupid. We know that it's happening. We let it go for some time, right? But we're not, like, enough's enough, right? Now, again, let's separate the what and the how. And I could also pitch the other argument to say, well, dude, you guys wrote the rules. You could have written rules for other things as well. And by the way, saying that, the Chinese are manipulating the currency, the other side of the same coin is that, well, they're buying treasuries, right? And they're keeping dollars, right? So it's also helping you, with arguably unsustainably low financing costs, right? So there's both sides for all of these conversations to be had. I think the point of this is really to say that sometimes, there's no bad intention in any of this, right? There's friction that's built up, and it's almost like the shifting of these tectonic plates. When it happens, you get these earthquake type events, but these things have been brewing for some time, right? And perhaps they were, somewhat inevitable. And I think that's a good segue to what the likes of Ray Dalio and the like have been warning about for a long time.
Yeah. So I've got this little chart that I wanted to share with you on, in his book, he kind of has this arc of history. Let me share with you the image. And I was like reading through it. So there's New World Order on the rise, peace, prosperity, productive debt growth, financial bubble, big wealth gap. We've lived through that. USA is a reserve currency, income rise and competitors copy, overstretches. I don't know if we're here there. Financial bust and economic downturn. Very much feels like we've been here as well. Printing money and credit cycle. And I feel like we're here. Revolutions and wars. It's a bit worrying. And we're heading towards this debt and political, because he has actually said some quite alarming things, Donald Trump. He said that, he might stop paying out on treasuries. He might stop paying out the interest on treasury, which is, it's kind of beggars belief, but, this stuff does actually happen. But yeah, interested to hear your analysis on, where we're sitting, and, do you agree with Ray Dalio on this big, spectrum?
I'll be honest, to be perfectly frank, I'm not qualified to disagree with the likes of a Ray Dalio or the others, of similar caliber, who have been exceptionally, really quite vocal over this last week, right? It literally feels like the who's who of world finance has been out on, one channel after the other, making sure that their voice is heard, right? So whether it's the like of Larry Fink or Jamie Dimon, or, the list goes on, right? There are a lot of people, and I'm sure there, however many I named, there'll be as many that I could have and I forgot to. So I'll stop at those three. But in any case, certainly I learn from these folks. I'm not qualified to disagree or agree. Right? I would be inclined to glean from what are they trying to say, right? What, not just Ray Dalio. The other one that comes to mind, I think, is Jeremy Grantham, from, I think it's a GMO, one of the large hedge funds as well. For a long time, these folks have been talking about the unsustainable trajectory of sovereign debt, right? That's one thing. And talking about bubbles and talking about, well, how are you going to get out of this, right? And Ray Dalio in particular has gone to great lengths to put this conversation into the public sphere, into the public domain, to raise awareness and education, to say, guys, history has repeated itself so many times on this same phenomena. We're next in line if we don't do something about it, right? And so what is it? What is it, right? Very simply, it's taking your status as a reserve currency manager, right? As having the reserve currency of the world for granted, right? Once you start taking that for granted, right, things start unhinging bit by bit by bit, right? And so we're kind of at this stage where we all enjoy the benefits of a strong and stable US dollar, right? Whether you realize it or not, living in the Western world. And in fact, if you live in the Middle East, even more so, right? The petrodollar and the like. There are very, very, very few places in the world now that don't enjoy the benefits of the US dollar as a reserve currency for the world, right? But then things happen that are unexpected, COVID. And what was the response to COVID? You print a mountain of dollars, more than we've ever seen in the past. And all of a sudden, people start becoming worried about, the strength of the dollar and the rigor, of this currency as a reserve. And, you start having, inflation is coming in and so on. And the Federal Reserve have really, I think, done a great job of late of kind of managing inflation expectations and kind of, giving this reassurance that they will act very firmly to ensure the value and the credibility of the US dollar regime, right? But now, we're kind of at this stage, well, maybe it kind of helps to have a slightly weaker dollar, right? But then how are you doing it? And there are some very alarming comments made by folks in or around the Trump administration. Because you've got to remember, the one thing I've got to say about Trump is, at least from an economic perspective, the folks he's had in the Treasury or the like, are incredibly competent people, right? And arguably much more so than some predecessors and the like. And so insofar as he's relying on them, I think that we're in a good place. But there are other voices saying, well, you've got to pay for the security umbrella, that the US provides. You've got to pay for, the dollar as a reserve currency. You've got to pay for this. You've got to pay for that. Well, that doesn't rest quite so easily, with certain allies even, especially when you're talking about expropriating land for the sake of natural resources, right? It was like, well, one half of the conversation makes sense, but not when you follow it up by, we want that land, right? Well, that's
stealing
not
land.
The security umbrella. If you're going to take what you want when you want, I don't know how any of this is going to unfold. All right, but in any case, Ray Dalio has made this very point that you stretch your military too far, you stretch your resources too far, you put too much reliance on your reserve currency status, your debt burden becomes too big, right? And you lose that bit by bit by bit, people start falling away by the wayside. This has happened many, many times in history. This is not new. In fact, he's literally given a playbook of, guys, this has happened so many times that we don't need it to happen again, right? And yet it's playing out exactly as he's kind of outlined many years ago.
And Mayur, now I guess getting into the practicalities for the people who are watching this, who've got their own portfolios, and you're an investor yourself, you manage your own portfolio. What should they be thinking about? Like, because you've managed as a trader through multiple crises yourself, and with the bank's monies as well that you were working for. What are the immediate things that investors should be thinking about in the short term? And then what are the things that we should now be thinking about in terms of the long term as well, where the chips are going to fall?
So there are a few things that come to mind. First is, generally speaking, there's, myself included, but there's a hesitance or reluctance, an inertia in recognizing significant change, right? And it's like, it can't happen, this wouldn't happen, like, to think that these drastic changes will occur, people really fight it, right? And yet, bit by bit by bit, the scaffolding kind of comes apart, and it tends to happen. And I was certainly guilty of this, and I was guided by my managers around the time of the financial crisis and somewhat before, that sometimes real bad stuff happens, right? Like, it's don't think that just because you haven't seen it, don't think that it won't happen. And I'm very grateful for for their tutelage and having heeded some of that. And so I guess the point right now is that people are looking at their retirement portfolio and so on and so forth, and saying, oh, my stocks are down 10% and so on. I'd say, look, it's important, but it's almost a little bit of a red herring, because some of the dominoes that are falling now suggest a much more significant change in the kind of financial order, which may or may not happen, right? But certainly the signs are there, right? And the dominoes are falling. And so the first thing I'd say is, when people ask me, what should I do? How much should I invest in the stock market, or what should I invest in? I find it really, really difficult to answer that question blindly, because the first order of business is to look at your own cash flow perspective, your own liquidity perspective, and then you deal with your capital perspective. It's always in that order. And again, something that I learned, in working with some very, very good people through various crises, right? That the first matter to deal with is your cash flow, right? There's no point putting loads of money in the stock market if you're fearful for your job, right? That doesn't make any sense. So you need to think about, what I do for a living, how tied is that to what's happening in the world, right? If I work for a company that exports 80% to the US, well, maybe I don't want to be betting loads in the stock market or whatever it may be. The next thing is your liquidity situation, right? What does your expense base look like? Another form of expropriation is taxes, right? And we in the UK are very much in the crosshairs, whether it's VAT on school fees or whatever else comes next, inheritance tax and so on and so forth. These are all matters that we're dealing with in the UK, right, at the moment. And then the last thing that you deal with is your capital base, right, your longer term savings plans and so on and so forth. So really what someone does in the immediate term really depends on their own particular situation when it comes to this triage of things. But let's fast forward and hope and pray that we're dealing with a very responsible and sensible kind of investor base with Cur8 Capital, and those folks who are thinking about long term, right?
Yeah.
I'm happy
So
to
before
jump
you
to
go,
that, but do you wanna...
yeah, yeah, before you go to the long term, because it's striking to me, so you, mashallah, you were one of the very successful traders in the city over a period of many, many years, and it is striking to me that we were talking, the bulk of your position at the moment is in cash, and that aligns with what people like Warren Buffett and people like Ray Dalio and others. That's their net current position as well, and so and part of me is thinking, is that because you guys are, I mean, perhaps not Warren Buffett, but there's an element of trading in your mindset, or is it that actually long-term relatively passive investors should take heed to that signal that
Yeah.
very astute investors are sending?
Yeah, I mean, as you talk about, you're all in cash. There's a very horrible scene in this film's, Civil War that came out about a year ago, with a nefarious actor kind of asked, what kind of American are you? And so the moment you said that, my mind jumped to, well, what kind of cash have I got, right? Because now not all cash is equal. So I was like, oh God, why would that scene come to mind of all things? I think the cash that I have is actually worrying me more than most other assets that I have, right? Just by function of what I've done, I tend to be largely US dollar based, as are very, very, very many people, right? Now, I'm not quite there in terms of, the US is done as a reserve currency, but, to stage manage the devaluation of a reserve currency, whilst you've got some very loud and different voices, right, in this administration is worrying, right? What may be in the history books just collateral damage, if this all works out well, right, is very, very painful in the here and now. And again, if you go back to, just for a moment, from 1930 to Bretton Woods, 10 to 15 years of transition, right? From Nixon to Reagan was what, 10-ish years, I'm guessing, of transition. So in the history books, 10 years of volatility or transition is just that, right? That's how long it took to reconfigure. But in the real world, living it now, 10 years feels like it's, the next 10 years is quite a long time to be dealing with this type of uncertainty. So, we've got to, almost change gears. When I say long term, I don't mean long term by way of history books, but I'm talking years, not months, right? And I think what's happening in terms of the reconfiguration of global economics warrants some long term, i.e. year-long, multi-year long planning. So what does that mean? Very simply, all of the folks are saying the same thing. You want to move to real assets, right? What does that mean, right? Well, the safe haven, one of the safe havens globally in terms of real estate traditionally has been UK, and in particular, London real estate. And so, living in North London, that's an obvious thing that comes to mind, to flick through Rightmove or Search Smartly, or one of the other great apps in terms of where can we find a good deal in terms of real estate. That's a very obvious one that comes to mind. And let's go through these very quickly in cycle, right? The pros and the cons. Yeah, I mean, London has been there, as a safe haven in terms of real assets for hundreds of years, right? And so it's certainly something that warrants consideration. There are two problems with it that I can see at the moment, right? Two very immediate problems. First of all, we're going through our own reconfiguration post-Brexit. Right, some of the biggest industries in the UK, banking for one, but certainly many others, have been upended, given what's happened, less than 10 years ago, and we're still working through a lot of that. And so, you don't have the same flux of international skilled labor coming in and through London, for work, right? And so you don't quite have the same demand for, London property in the way that you did, for a long time. And the second thing is, the UK is understandably going through its own reckoning in terms of, how do we finance our, sovereign debt burden, and the method being used at the moment, rightly or wrongly, is tax, right? So whether it's we're going to take a bit from the farmers, a bit from your inheritance pool, a bit from your pension, a bit from school fees, a bit from wherever, it doesn't feel as though this trajectory is going to keep going, is going to stop, right? And the elephant in the room in the UK will be property assets, right? That's where most people have their savings kind of tied up, and so it's a little bit, where if you're an international investor looking at UK property, yeah, okay, it's there on the list, but what else is there? Gold, right? Now, gold has been, the asset class that's kind of that's flown first and been out the gates and really shown, that it's where a lot of this money is going, right? And then you get other, kind of, you get other rhetoric online. Oh, the Chinese, they're dumping treasuries and they're buying gold and this, that, and the other. I don't know. I'm not in the room. Maybe not. I don't think that the Chinese would act in such a haphazard manner, right? I don't think it serves their interest. I don't think that they act in such a short-termist type way. But people will preempt these moves, right? And say, well, if you're going to devalue the dollar, and if you're going to force the Chinese to rebalance, the trade deficit, then the other side of the same coin, again, is that the capital balance, the capital accounts surplus will change, and they will need less by way of treasuries. They will have less dollars to invest, and they will diversify, and gold will feature, right, in terms of where the Chinese and the Indians and the like, will park some more money, right? There's a problem with gold in that, look, how many gold bars or gold coins are you going to stuff under your mattress before you start getting worried, right, about that being a security risk in your own home? And so chances are you're going to hold it through ETFs, right? You're going to hold it through as a financial instrument. Once you do that, you don't own the gold, right? It's in some vault somewhere, right? In the same way the government wants to tax you, there have been episodes in history where they've just taken a certain amount of your gold, right? Or they've forced, those that have gold in an economy to relinquish it, right, as a means of, give it to us, so we're going to come in and take it. Now, I hope, and I'm not suggesting that type of thing would happen again, but the moment you hold gold as a financial instrument rather than a hard asset, it loses some of that benefit, right? Because gold held through an ETF is also levered. And so if people need to liquidate assets, right, and they need to raise cash, they're going to dump their gold, right, by way of ETFs as well. And so you start testing. Yep.
Yeah. So I wanted to, I mean, we're onto an interesting thread, and I'm just conscious of time, and I wanted to share this really interesting image with you, Mayur, and just get your, your reactions to it. It's an image of the the world economy according to the visual capitalist. I'm not even sure I can fit this onto my screen properly, but it kind of gives you a sense of the relative size of all the global economies. And I was having this chat with Mohsin as well, and his perspective was, and I have sympathy for that perspective, which is that, look, ultimately, in the long term, I think a lot of these countries that are looking at the USA right now and what's happening are going to be worried that we've been all in on the USA for so long that clearly we need to have a little bit of a readjustment. But the reality is that the USA is such a large part of the world's economy that Mohsin's perspective was that we're always going to have a portion of our investment, certainly in our lifetime, that's going to be USA flavored. But I'm interested to hear your thoughts, perhaps triggered by what I've said or this graph.
There are two things that this graph doesn't really show. First of all, if you took the same graph 10 years ago and then took it 10 years prior to that, and then 10 years prior to that, if you looked at that changing landscape, there'd be, I think, more of an appreciation as to why there are certain folks in the upper echelons of the US economic hierarchy who are concerned, right? Because they've seen that proportion shrink over a period of time, right? And that shrinkage has only accelerated. And certainly if you look at the potential of the likes of India, but certainly that bottom right segment, all of the population growth, the economic growth, so much of that really is coming from within Asia. And all you need to do is, visit anywhere in Asia, right? And, the airports are new, the roads are new, the infrastructure is new, everything's new, right? The shopping malls are new, all the rest of it, right? And so that's one thing that this is not showing. The other thing it's not showing is, how the US has sustained itself economically, which is borrowing a lot of money. Who has it borrowed money from? China, yes, but even the likes of Japan, right?
Yeah.
The biggest creditor is Japan, it's not China. And so, the rest of the world, has helped finance this US exceptionalism, as it were, over this last period, this last phase, right? But to your point, yes, I certainly don't count the US out. This is very much a case of the US is pulling up the drawbridge. This is not that others are running away, right? And so it remains to be seen how far up they pull the drawbridge, right? I don't know. We'll have to see. But I think there are two or three things that warrant concluding are equities. In periods of inflation, equities prove to be a good asset class. And that remains my primary area of focus. Right now, which equities? That's the real question. And so, that's something where I feel, the passive investing instruments they'll catch up because they kind of rebalance every 3 months anyway. And so if you were with it and you stuck with it, I don't think that's necessarily a bad outcome. And so when people are asking last week, should I sell all my equities? My answer is kind of like, first of all, I can't say without knowing your cash flow situation, etc. But if you don't need the money in the next 5 to 10 years, my answer would be no, don't. Right? Because being in cash is perhaps more of a risky proposition now, because it's a nice idea that, I'll buy it back at the bottom, but very few do. The bottom's the bottom for a reason, right? And the markets tend to bounce back very, very quickly. But there's certainly there's a clear argument for, well, I need to rethink about which ETFs I have, and perhaps go from an S&P market weighted to perhaps an equal weighted, perhaps go from a US centric to a global centric, something along these lines. This type of readjustment is warranted, in my opinion, but I wouldn't count equities out, right, for sure. Personally, and for those that are in a position to do so, I think there's immense value in trading the equity markets rather than passively investing, but that really requires having a framework, having some time, having a little bit of rigor and focus, and frankly, it's got to be something that you're interested in, right? Something that you enjoy doing, because the truth of trading is that you end up doing it for 12 months of the year, or let's say 10 months of the year, but most of your revenue or your profit comes in only 2 or 3 of those months, right? A lot of those months you're kind of treading water, and that's just part of the game. So if you like doing it, then absolutely you should do it. I find it to be thoroughly interesting and something that I don't want to stop, and certainly being quite fruitful in environments like this, but it requires a lot of time, right? I wouldn't just go kind of gung-ho in this.
I mean, this is a side point, and people who are watching you don't necessarily shouldn't really copy this, because I'm certainly not going to be copying this. But out of interest, are you seeing interesting buy opportunities on individual shares at this point?
There are. I must be honest. I'm a little bit cautious still, right? Just given it's quoting from others, not my words, but bottoming is a process, it's not a day, right? And so now you've had the liquidations, you've had some of this stuff is broken, you need to give it a little bit of time to rebase and to kind of come back in. But yeah, no, certainly I've been screening through the weekend, and I can find over 100 stocks that look quite interesting here, right? So I certainly think that there's still fertile ground there. I think the last two things very quickly, also conscious of time, but one, crypto, right? Look, crypto hasn't proven itself from my perspective. And so it's a very interesting thing to kind of play around with, but it's got all the wrong correlations. Crypto tends to work when penny stocks work. It doesn't work when gold works. And so as a store of value, which is what I want it to be, it's not proving itself in that regard, right? And also, where's my crypto? It's not on a hard drive in my desk, right? It's on some exchange somewhere else. And so how safe do I feel, with what's happened with FTX and various rounds of hacking and, so on and so forth. And even moving crypto it feels to be quite a dangerous thing, right? The moment you try and move it from one place to another, I've heard so many horror stories about, I've just lost, this and that and, all sorts in that transition. So that's a worrying one. But when it comes to, my nexus with yourself at Cur8 Capital and the like, there's one thing that people take away from this conversation, is that being in uninvested cash is dangerous, right? To have your savings sitting in the bank, not earning money, is one of the worst things you could do, right? I don't believe, and I've been a recipient of this by virtue of what I've done, but there was always, I guess, something that felt uneasy about just earning interest, right? And so whatever interest I receive, I will give away. I don't want to earn interest, but the interest is there because your money's losing value. So if you're not even going to earn interest, which I'm not advocating that you should, right? You need to find a way to put your money in some real asset or some income generating assets, right? Because otherwise you're going to lose more, right? This is the inverse of compounding, right? This is death by 1,000 cuts. Over 5 to 10 years, the cat's out the bag in terms of inflation. And what the current Trump regime or the US regime is telling us is, maybe a bit of inflation is a good thing. And actually, if the dollar is weaker, we can afford higher rates and we can accept higher inflation because that's the means through which we're going to reconfigure. And so the worst thing you could do, right, is have cash at home. I presume people wouldn't have large amounts of cash at home, but don't have large amounts of cash in your current account earning nothing. That's the worst of all outcomes. And so again, we come back to, you're in cash, but what kind of cash do you have, right? Like, what are you doing with your cash? The best things that I've done is kind of diversify, not entirely, but partially to Swiss francs, to the pound. Why? Because that's where sovereigns and other central banks, that's what they're going to do, right? Let's dilute our dollar holdings a little bit, right? Let's go into some of these other traditional hard currencies, right? And then let's figuring out what we can start buying with those, with those currencies, right? And amidst all of this, yes, the biggest contingent is still by far and away going to be the US capital markets. And so you can certainly find a lot of things in dollars, right, which still give you a good profit share, that still give you, some good return. But the worst of all outcomes, in my opinion, is to be complacent with cash. That's the worst.
Yeah. Mayur, these have been wise words. I've learned a lot. I'm sure our audience have learned a lot as well. And we're definitely going to get you back on in the future as well. Thanks for all of some of the attendees for their comments. Someone was asking about bull cycle versus bear cycle. Where do you think? What 30-second answer? Are we in a bull cycle or a bear cycle?
No, I mean, the S&P has yielded not more than 20% for the last 2 years, right? And so there's a joke of, when I see a bubble, I run towards it, right? When I see a bull market, I run towards it. So if you'd asked me at the beginning of the year, are we in a bull market, bear market? Of course, we're in a bull market, and long may it continue, right? Until it's not, right? And I guess now I guess it's not, right? And so, if you look at stage analysis, there's a great book by Stan Weinstein. If you haven't read it, that's the first book that I would read in terms of understanding bull and bear markets and cycles. But he's, what you'll talk about in terms of a stage 3, which is kind of you've topped out, you thought you'd keep going, but you're kind of stalling, and now you're coming down, right? So Many are saying perhaps we're already in recession. Certain indices have already moved into bear market territory or correction territory, but we're certainly on that downward trajectory. And there's no signs that it's going to stop. Right? We should have picked up in terms of the equity markets today. I don't know what's happened in the last hour, but it doesn't feel as though we're doing so convincingly. And so now the trajectory's down. Right? So we're in that verge into the bear market.
Yeah. And then someone else is saying, I find no safe haven in any asset, focus on the risk pause for now. Someone else is asking, At-Tariq is asking, are properties in northern UK worth investing in? So yeah, I mean,
this wasn't meant to be a plug, and this isn't the reason I came to speak. We were talking about these things, and you said it would be good to get your ideas on a broader call, and that's what we're doing. But I'd say absolutely. The first port of call, most sincerely, something that I do is to look at the product suite that Cur8 Capital have available, right? Because there's no safe haven, but actually some of the stuff that they have and they're working to curate, as it were, is very, very good, right? And I certainly hope to help make it even better, God willing, as a self-interested party, right? And so I think there are things out there. It's not obvious. When these tectonic plates change, and regime change has been part of human history forever, right? But it's an impetus to go and do a bit of homework and to learn a few more things. And I think there is stuff out there, but it's not obvious and it's not easy. It requires a bit of work. But I think the product suite that Cur8 have out there are very, very good. And I can't really comment on north of the UK. Look, some things that are cheap stay cheap for a reason, right? It really comes down to job growth. Unless people are going there for jobs, I don't know what's really going to redrive, what's going to change, the dynamics of the property market. And I'd say, look, right now, unfortunately, it feels like I say unfortunately, but I'm kind of okay with this, but London's getting cheaper. Right. And so it's hard to see an instance where the rest of the UK is going to go up when London's getting, when London's going down. And again, the most levered of all asset classes is property, right? Or not necessarily the most, but certainly it's up there. And so if you've got structurally higher interest rates, that it's very, very difficult for any property, to do well. So when I talk about the long term, I mean, you've got to be buying through this cycle and thinking about preserving your wealth over the next 10 to 20 years. I'm not talking about, the next 1 or 2 years. That's not it, right? The next 1 or 2 years is a time where we reconfigure, right? And we kind of reorientate our portfolio. And so I think in terms of the immediate term, I don't think it's a case of panic, but I think it's a case of like roll up your sleeves, do some work, read some books, speak to some people, look at what Cur8 and the others have out there, and then start thinking about your own hierarchy, your own triage in terms of cash flow, liquidity, then capital, and start building your own financial plan, right? To not do so, I think, is the worst and the most dangerous of these scenarios.
Mayur, it's been a pleasure. Thanks everyone for tuning in, and please let us know in the comments below what other topics you'd like us to cover. We'll hopefully, God willing, get Mayur back. Maybe we'll do a deep dive Q&A on where you can just chuck investment categories at him himself, and he'll get his hot take on it. Until next time, Assalamu alaikum.
Welcome, salam.